Hi, I'm Janelle Cross. Welcome to this workshop, Understanding Your Credit, How to Fix It, Build It, and Protect It. If you've attended another workshop, you've been introduced to the 3 stages of financial wellness. If this is not familiar, plan to join an Intro to Money Nav session offered at the beginning of every month. Also, our Money Milestones course takes a deep dive into the 3 stages. Understanding Your Credit is a Stage 1 financial safety course. Before talking about how to improve your credit score, let's review how it works. First, a credit score is just a numerical expression of a person's credit worthiness, and the higher, the better when it comes to this metric. To determine your credit worthiness, creditors use your score to predict if you'll make a reliable investment. Your score determines whether you qualify for a loan, what interest rate you'll pay, and how much credit you'll receive. Credit scores range from 300 to 850. Considering that few Americans land in the excellent range, chances are there's something you can do to improve your score. Having a good credit score is important because it impacts things like getting approved for credit cards, loans, and qualifying for lower interest rates. In this workshop, we'll walk through 5 things you can do to move your score toward excellent. Equifax, Experian, and TransUnion are the 3 main credit reporting bureaus. They collect your consumer information and then provide the information to creditors in the form of a credit report. This credit report contains your credit score, which is also called your FICO score. The 5 components of your FICO score are payment history, which counts for about 35%. Amounts owed, or how much of your credit line you've used, is about 30% of your score. Length of credit history accounts for 15%, and the types of credit or credit mix is about 10%. Finally, the establishment of new credit contributes about 10% to your FICO score. Making payments on time is the biggest contributing factor, with your payment history accounting for 35% of your FICO score. For this reason, the first step to improve credit is the most obvious one: pay your bills on time. Missing even one payment by one day can negatively impact your score. Delaying 60 or 90 days can pull your score down significantly. And when creditors look at your score and see a missed installment, it's like throwing up a red flag. They'll see the missed payments and assume that you represent a credit risk. They could deny your credit or increase your interest rate. Even worse, those missed payments will linger on your credit report for 7 years, even if you close the card or pay off the balance. If you've only missed one payment, it doesn't hurt to reach out to your billing companies and ask about removing that missed payment from your record. If you have a track record of making payments on time, they might be forgiving. A good habit is to set up automatic payments or reminders to pay the minimum well before the due date. Then, make additional payments and ideally pay off your balance when you settle up your finances. I do this monthly, but some folks do it every pay period. The frequency is up to you, but we recommend you balance things out at least once per month. Our second good habit is to correct any errors on your credit report as soon as possible. Everyone is entitled to receive a free copy of their credit report annually from each of the 3 bureaus. You can request yours by visiting annualcreditreport.com. Your credit report contains all the information used to calculate your score. And credit bureaus are not perfect, so they can and do make mistakes. The most common errors you may find are identity mistakes, incorrect account details, and fraudulent account errors. An identity error can range from having the wrong phone number to something more troublesome, like mixing up your credit score with someone else's. The second error that will affect your score is having incorrect account details. For instance, if closed accounts are reported as open, or if open accounts have an incorrect credit limit listed. The most serious mistake is someone trying to steal your identity and open lines of credit with your information, but without your authorization. Check the credit lines reported and make sure you opened them yourself. If you identify an error, dispute it immediately with the credit bureau that's reporting incorrectly. You'll need a copy of the credit report containing the error and supporting documentation. Taking the necessary steps to correct errors can be time-consuming, but can also make a huge difference in your score. How old is your credit history? Some people get a credit card as soon as they can and others wait until they need it, but the truth is the age of your credit has a big impact on your score. Creditors want to see that you've had credit lines open and are making payments. The longer the account is open and in good condition, the better it is for your score. We'll talk more about this in a minute, but this is a reason to consider opening a credit card for responsible young adults. One big misconception about debt is that closing out old credit lines will help your score, but it can actually have the opposite effect. Keeping old accounts open and functioning with a history of on-time payments allows your payment history to grow and improves your credit score. If your past debt mistakes are severely bringing your score down, then you may consider closing the account. But remember, those mistakes will still carry on your report, impacting your score for at least 7 years. All that said, the longer your history of good debt usage, the better your score. So keep debt lines open as long as possible. What's your credit utilization ratio? Your credit utilization ratio is simply the amount of outstanding balances on all credit cards divided by the sum of each card's credit limit. The lower the percentage, the better your score. Creditors prefer to see a utilization ratio of 30% or less, but there is no magic percentage when it comes to this. Bringing down your ratio can have a positive impact on your credit score. If your ratio is over 30%, there are ways to lower it. For starters, try to pay off your balances in full every month. Or call the lender and try to get your credit limit increased. To determine your ratio, you can click on online calculators, like this one available from Dollar Sprout. The final way to improve your score is easier said than done. Stop overspending. If you reduce spending, it'll reduce the amount of debt you have to repay and make improving your score easier. Building up debt is more than overspending, though. For example, did you know that if you agree to co-sign for someone and they default on the loan, it will reflect on you and your credit score? If you don't already have one, now's the time to build a spending plan. Our Dollars and Cents workshop has more information on that topic. This is also a good time to create a debt reduction plan if you need one. A good source is credit.org. They offer credit and debt counseling services at no cost. Also, check out our Living Debt-Free workshop. So far, we've focused on ways to improve your score, but what if you're just starting out? Building credit can be like a chicken and egg riddle. You need credit history in order to obtain credit, but how do you get credit without a history? Banks have created ways to get your credit train started on the right track. There are things like secured credit cards that are backed by an account that a lender can access if payments aren't made on time. There are also programs called credit builder loans that help you build your credit. There are some financial transactions that don't automatically track to your credit history, including rent and utility payments. Check out websites like rentalkarma.com and RentTrack so that you can get credit for these on-time payments. Another important component of the FICO score is your credit mix. So you don't want to just have credit cards or just have a mortgage. A variety of credit and loan types is good for your score. This includes credit cards, mortgages, auto loans, student loans, and bank line of credit. As we wrap up today, let's take a moment to see just how much credit impacts our financial resources. This chart shows 4 expenses that are influenced by your credit score: mortgage interest rates, auto loan interest rates, the cost of insurances like car insurance, and credit card interest rates. You can see how folks with higher scores pay less, and the difference can be significant. Look at the difference in interest rates for, say, a car loan or a credit card between someone with poor credit when compared to someone with an excellent score. And those interest rates translate into real dollars that you'll have to give a lender instead of spending on yourself. The difference between fair and excellent credit scores can cost over $100,000 more for a mortgage. So as we wrap up, let's review some good habits that will get and keep your credit on track. Check your credit reports annually. annualfreecreditreport.com is the federal website. Check your spouse's credit. Think twice before co-signing. Keep good debt lines open, especially if you have a long history of on-time payments. Don't be tricked by offers. One thing to watch out for are the store credit card offers. Interest rates for these cards are typically very high, despite the savings they offer you at the cash register. Keep your debt utilization low. Ideally, aim to use less than 30% of your available credit line. And finally, build your credit history across a variety of debt types. That wraps up this Understanding Your Credit workshop, but don't stop your wellness journey here. Keep taking the best next step. Google is full of advice, and so are family and friends, but not all advice matches your situation. Your MoneyNav coaches are here to help you figure out what the best next step is for you right now so you wind up where you want to be. A great next step is to complete your MoneyNav assessment. This questionnaire takes about 5 minutes and results in a series of to-dos or best next steps that are built right into your personalized My MoneyNav dashboard. For a link, email your financial coach at moneynav.com.